We are back, traders. Got a flood of questions from you awesome people, and it's time for some answers. Let's get this question and answer party started. Before I forget any of them, please hit that like button if you're ready for some knowledge bombs, or maybe just some silly ramblings. Question 1. How does one overcome fear of making an entry? Due to previous experiences, I have always gotten my analysis right. But because I fear to enter the market, I'm late for the entry, which causes drawdowns. At Kevin McDonald Gaming 1936. Hey Kevin, this really resonated with me. I used to struggle with the same fear you're feeling right now. But listen, it's completely normal. We're all human after all, and fear is part of what makes us who we are. The key to success here is learning to manage that fear. And here's what worked for me. 1. Backtest and forward test your trading strategy. Backtesting gives you valuable insights. Did your strategy generate consistent profits? How did it handle volatile periods? Were there any drawbacks or unexpected outcomes? Once you've backtested and are comfortable with your strategy, it's time for forward testing. This involves applying your strategy to real-time data following your backtesting window. This is crucial because markets are dynamic, and what worked in the past might not translate perfectly to current conditions. Forward testing helps you assess how your strategy adapts to changing market environments. Does it still generate profits? Are there any new weaknesses exposed? When you do this, events in the future, like when you are trading with real money, won't have much impact on your trading decisions. You would have seen similar scenario during the backtesting and forward testing stage. 2. Plan your trades and stick to the plan. This means figuring out your entry and exit points before you ever buy or sell. Consider your risk tolerance too, which is how much you're willing to win or lose on each trade. Your plan should entail your take profit and stop loss points. This will help you eliminate the emotion of fear from your trades. Remember, the market takes as much as it gives. 3. Start small. Ease into things by making smaller trades at first. This will help you get comfortable with the market's ups and downs and build your confidence. 4. Be disciplined. Once you have a plan, follow it. Don't let fear, greed, or FOMO throw you off your trading plan. You already have backtested and forward tested your strategy, and you have a trading plan. You don't need to be fearful, you need to be disciplined and follow the plan. 5. Learn from your mistakes. Keep a trading journal to track your trades, analysis, and results. Reviewing your past performance can help you identify winning strategies and areas for improvement. 6. Focus on quality over quantity. Don't feel pressured to trade constantly. Start by analyzing daily charts and devote more time to your other activities. You might be surprised how much better you understand the market by focusing less on frequent trading. 7. Stay informed, but avoid overload. Keep up with market trends and news, but be mindful not to get bogged down by too much information. Analysis paralysis is a real thing. Kevin, I truly believe you can achieve success in trading. Keep at it. Question 2. Why do I find it difficult to hit my TP most times? At Dorkanu Believe 1351. This is another interesting question. I understand your struggle. I've been there myself. This might sound simple, but mastering it takes dedication. Like I said before, I focus on constantly improving my entry and exit strategy. We all hear about risk-reward ratios, but one key thing nobody mentions is liquidity, where most traders place their stops and profits. Here's the thing. Price tends to reverse near these areas because that is where there's a lot of buying and selling activity. Ideally, you want to take profits around these zones too, but how do you spot them? The answer: screen time. The more charts you watch and analyze, the better you'll understand price behavior. It takes practice, but the rewards are worth it. This is where good risk management comes in. You need to stay in the game long enough to learn by experience, and that means managing your risk wisely. Keep at it, and you'll see more winning trades accumulate over time. Question 3. How do you know that you've got the right trading psychology? When and how do you know that you're responding appropriately to market movement? My reason for this question is we make profits sometimes in the market not because we are good traders or that we got the best trading system, but sometimes it's because of mere luck. So how do you know that your decision-making is improving toward the market, and how do you know your trading psychology level? A. Gerald. Thank you, Gerald. You are becoming a regular on our Q&A, and I like that. That's a great question you just asked, but the questions are layered, and I will answer them one after the other. The first question I will answer is how you gauge how strong your trading psychologies become. Let me share some signs of strong trading psychology. 1. Sticking to your plan. This is when you follow your predefined entry and exit points to the T. You avoid impulsive decisions based on emotions like fear or greed. 2. Learning from losses. You analyze losing trades to identify mistakes and improve your strategy. You don't get discouraged by losses and accept them as part of the game. 3. Disciplined risk management. You prioritize risk management over maximizing profits on every trade. You have a clear risk tolerance and stick to it. 4. Emotional detachment. You can manage your emotions and stay calm during market fluctuations. You don't let wins or losses cloud your judgment. 5. Continuous learning. You actively seek to improve your knowledge and refine your strategy by studying markets, backtesting, and learning from other traders. The next question of how effective your response to market movements has become is easy to answer. Just ask yourself the following questions and note what your answers to those questions are. Are you a market chameleon? Do you constantly switch strategies? Do you force trades that don't fit your plan? Do you even have a plan? Or are you just winging it? Do you track your trades to learn from them? The key here is to focus on the quality of your trading process, not just the outcome of each trade. And talking about luck, while it can play a role in short-term wins, consistent profitability over the long term indicates skillful trading, which is a surefire way to tell your trading psychology is where it should. If you can't replicate your success consistently, if your wins are sporadic and not backed by a solid strategy, it might be luck. Developing strong trading psychology and market responsiveness is an ongoing process. It takes time, experience, and continuous learning. Keep at it, analyze your results, and focus on the process. That's the recipe for building a successful trading mindset. Question 4. Some weeks I traded flawlessly, following all my rules, stops, and take profit. And most weeks, it seems like I throw all these away and blow another account. How do I keep my discipline to stay profitable and in the game? At Sabotage A7179. It sounds like you're experiencing a common challenge for many traders: inconsistency. Here are some tips to help you maintain discipline and stay profitable. 1. You need to identify your emotional triggers. When do you tend to abandon your plan? Is it fear of missing out during a winning streak, or fear and panic when the market goes against you? Recognizing these emotional triggers is the first step to managing them. 2. You need to work on developing a coping mechanism. It can be taking a break from trading when emotions run high, or using relaxation techniques like deep breathing, or having a clearly defined exit strategy to avoid impulsive decisions. 3. Start rewarding yourself for being disciplined and sticking to your trading plan on the days you do. This is because positive reinforcement can be powerful. Set small rewards for sticking to your plan, even if it's just a mental pat on the back. This will help solidify good trading habits. 4. Focus on the long term. Even the best traders experience losing streaks. Don't let setbacks discourage you. Playing the long-term game will help you trade without pressure, thus developing your skills slowly and consistently. Trading is a marathon, not a sprint, and developing consistent profitability takes time and dedication. Don't get discouraged if you don't see immediate results. Stay focused, keep learning, and refine your approach. Question 5. How can I grow a small capital in trading? And as a beginner, what are all the pitfalls I can avoid? At Surya Saktagal. Hello Surya, the answer to your question is very simple. Trade your small account as you would trade an account of thousands of dollars. Of course, you want to make money quickly, but you can also lose it quickly. Trading with a small account requires extra caution. Even though the basic trading ideas stay the same, managing risk is even more important. You can't risk blowing up your account with a single bad trade. The key is to trade smaller amounts. Don't invest a big chunk of your capital on each trade. Scale down your position sizes to fit your account size. Focus on small, consistent wins. Don't get greedy and chase big profits. Aim for steady, achievable gains that gradually add up over time. Remember, even small wins can snowball into a much larger account if you reinvest them wisely. Here's an example. Imagine starting with $200 and making the consistent 3% profit each month. By reinvesting those profits, compounding, your $200 could grow to over $285 in a year. That's a 42.58% return, which might seem small to some, but it beats what most banks offer with a savings account. The point is, with consistent effort and smart risk management, even a small account can grow significantly over time. Question 6. What can I do if I have a losing streak? What mental exercise can you recommend? Nambanto Brayansplain. Losing streaks are a frustrating but inevitable part of any trader's experience. Here's what you can do to navigate them, and a mental exercise to help you bounce back. Step away from the market and clear your head, then come back with a fresh perspective. Emotional trading often leads to further losses. Secondly, review your trades. Analyze your recent trades, both winners and losers. Identify any recurring mistakes or areas where your strategy might be failing. You need to also ask yourself if you are sticking to your trading plan. Did you manage your risk effectively? Are you focused on executing your strategy well, even if the results aren't what you hoped for? Then you can refine your trading strategy or risk management approach based on your analysis. Maybe backtest some adjustments on historical data. Finally, practice discipline. A losing streak can test your discipline. Remind yourself of the importance of sticking to your plan and avoiding impulsive decisions. This exercise can help refocus your mindset and maintain a positive outlook. 1. List the things you're grateful for in your trading journey. This could be anything from learning opportunities to the skills you've developed to where you think trading can take you to. 2. List the things you've learned from your recent losses, because every loss holds a valuable lesson. 3. Visualize your next successful trade. Imagine yourself executing your plan flawlessly and achieving a profitable outcome. By taking a break, reviewing your trades, refocusing your approach, and practicing gratitude, you can emerge from a losing streak stronger and more determined. Successful traders don't avoid losses. They learn from them and adapt their strategies accordingly. Wishing you the very best. We will be back next month, but before then, it is highly recommended you watch this video packed with wisdom from experienced traders. You will learn a lot from them. Please, don't forget to like, share, and subscribe if you are new here. Thank you for watching.